Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this chapter we are revising chapter number 13, which is about performance measurement and control. So let's get started. This chapter is primarily comprising of ratios. So whatever ratios we have learned to measure performance and evaluate whether the goals have been able to achieve or not. So this is what we have learned, and let's revise this chapter. So there have been a lot of ratios which we have learned. These ratios can also be divided into categories. The first category that we can talk about is the profitability ratios. So let's talk about profitability ratios first. We have been learning these ratios in a lot of papers. So if PM is not your first ACCA exam, or if you're not very new to commerce, you would know these ratios already. So if I talk about the gross profit margin, so that will be equal to gross profit upon revenue multiplied by 100. So it shows you what percentage is your gross profit compared to your revenue. Then again, another profitability ratio is your operating profit margin. And this can be calculated using operating profit divided by revenue multiplied by 100. Then you can also calculate a return on the capital employed, and this also falls under profitability ratios. If you know all of these formulas already and do not want to revise the formulae, then you can skip to the further part where I discuss how you can assess the performance, what are the problems with the use of indicators, and what are NFPIs and important external considerations. So please feel free to skip to that part if you already have revised the formulas. So you can calculate the return on capital employed using operating profit divided by capital employed multiplied by 100. Another formula which you can also use is operating profit margin multiplied by asset turnover. Both of these formulas are going to give you your return on capital employed. The formula of asset turnover is revenue upon capital employed. Now let's move on to the second category of ratios, which is liquidity ratios. So talking about liquidity ratios, first of all, we discuss about the current ratio. Current ratio is nothing but current assets divided by current liabilities. So this is how you find out the current ratio. Then second formula is your quick ratio. Quick ratio can be found out using quick assets, or what you can also say are current assets minus your inventory. And you divide this with the current liabilities. With this, you arrive at the quick ratio. The idle current ratio is 2:1 and the idle quick ratio is 1:1, just to remember this. Then you can talk about inventory holding period. So for how long is the inventory with you in the storage before you actually sell it? So that will be inventory divided by cost of sales multiplied by 365. This is going to give you an answer in days. Then receivables collection period. So receivables, how much are your receivables? And you divide that by the credit sales. Credit sales are the reason that you have these receivables. So divide that and multiply that by 365 to get the number of days. Then you can also calculate your payables period. Payables period is nothing but payables divided by why those payables are there, because we have purchased things on credit. So credit purchases multiplied by 365. So these are the liquidity ratios. Then the third category of ratios is the risk ratios. So with the risk ratios, first comes your financial gearing. Financial gearing can be found out using two ways. You can use either, both will be correct. Either you can take debt upon equity up into 100. The other way to find out is debt upon debt plus equity into 100. Another formula is the operational gearing. Operational gearing can be found out using fixed cost upon total cost multiplied by 100. You're basically seeing that out of your total costs, how much are your fixed costs. Then you can also work out your interest cover. Interest cover is nothing but your PBIT, profit before interest tax, divided by the finance cost. You get an answer in times over here. So how many times can your profit before interest and tax cover the finance cost is what you find out. Then dividend cover. Dividend cover gives you how many times your net profit after tax and preference dividends can cover the dividends that you are paying. So net profit after tax and preference dividend upon the dividend. This is also going to give you an answer in times. Now with this, we are done with the discussion over formulas. Now let's discuss how can you assess the financial performance. Assessing financial performance. So number one thing that you're going to do is you work out the ratios, you calculate the ratios. Second thing that you do is you comment that whether that ratio is good or not. Thirdly, you discuss the reason why the ratio is like this. Then let's also talk about what problems can be there with using financial performance indicators to measure performance. So problems with using FPIs to monitor performance. Number one problem is that short-termism is promoted. When you're only looking at the numbers and not the quality, you are promoting short-termism. Manipulation of results, definitely a lot of these figures which we have used in the formulae are, accounting figures, and these are very easily manipulated. So manipulation of results can be done, and it does not convey the full picture. So whatever your gross profit is, whatever your net profit is, it does not tell you how happy your employees are, how happy your customers are. So using financial performance indicators does not convey the full picture. Now let's discuss about non-financial performance indicators, how these problems can be overcome using NFPIs, non-financial performance indicators. So let's discuss. First technique which we have over here is the balanced scorecard model. Balanced scorecard. So there are four perspectives over here that we discuss. First is the customer perspective, how happy, how satisfied the customers are with the products and the policies of the business as a whole. Then internal perspective, so over here the management, the employees. Then you talk about innovation and learning, what the business is doing to continuously improve in what it does. The research and development, are we doing any innovations? And then fourthly, financial, because money is important too. So how good are we doing financially? So this is what balanced scorecard does. Another way where you can use NFPIs to measure or assess the performance using your building block model. Building block model. So usually this is useful for service industries. It is specifically designed for service industries. There are dimensions, there are standards, and there are rewards. Dimensions, standards, rewards. So when it comes to dimensions, there are determinants. Determinants. You know, what are the factors which determine these dimensions? First is quality. Second is resource utilization. Thirdly, you have flexibility. And fourthly, you have utilization. Then what are the resultants? If you know these determinants are taken care of, what happens as a result? As a result, you get a good financial performance and you get competitiveness. Then when it comes to standards, standards are ownership, equity, and it should be achievable. Then talking about the rewards, there'll be clarity, there will be motivation, and there will be controllability. This is the building block model. Moving on to the last topic in this chapter, this is about important external considerations. You know, in the above model, there's nothing really external which we have considered. So what are the important external considerations? First of all, you should consider the stakeholders. Some external stakeholders are also there, like the government, tax authorities, competitors. So competitors come in over here. And another thing is the market conditions, how the market currently is. That's also going to affect the business. So with this we have come to an end to the revision of chapter number 13, which is on performance measurement and control. We'll meet in the next video for chapter number 14. Thank you so much for watching. I hope that this was helpful.